Welcome to the Pro Ticker Deep Dive. Right now, there is a $48 heavy blend fleece hoodie just absolutely flying off the shelves in the crypto community.
Oh, yeah, the orange standard one.
Yeah, exactly. Made by a brand called Orange Standard.
Right.
And the text on the front of it just simply reads, Bitcoin, not crypto.
Right.
And the marketing slogan that they're using to sell this thing, it literally tells buyers, the market is loud, your conviction isn't, zip up, tune out, stay focused.
It's actually, it serves as like a perfect physical representation of a really specific market psychology right now. I mean, the design intent is literally to insulate the wearer.
Yeah, quite literally.
Wait, right, like you put the hood up, you zip that heavy metal hardware all the way up to your chin, and you just attempt to block out the severe volatility that's happening on the screens right in front of you.
But, I mean, here is the brutal irony of trying to tune out the noise right now, right? You can't just zip up a piece of fleece when the foundational architecture of the entire market is cracking under your feet.
You really can't.
We are recording this at the end of June 2026, and Bitcoin is it's hovering precariously below that critical $60,000 threshold. And the noise people are trying to ignore, it isn't just, retail chatter on social media anymore.
No, not at all.
It's the sound of an entire industry's plumbing just being violently ripped out and re-engineered in real time.
And that structural reengineering is, well, that's precisely what we're going to examine today, because this current environment is it's not merely a cyclical drawdown.
Right.
We are witnessing a systemic metamorphosis. The capital flows, the corporate treasuries, the actual physical infrastructure of the network, and the legal frameworks are all just fundamentally mutating.
Yeah, and this deep dive is curated specifically for you, our listener. You tune in because you want to understand the mechanisms behind the charts. Like, you don't need us to explain what a blockchain is.
Right, we're past that.
Exactly. But you do want to know exactly why the market is behaving the way it is right this very second.
So to give you our roadmap for today, we're starting with the macroeconomic pressure cooker that is basically forcing heavily leveraged corporate players into a really tight corner.
It's a huge corner, yeah.
Then we're going to look at how the actual producers of the network, the miners, how they're abandoning their original business models to pivot toward, of all things, nuclear-powered artificial intelligence infrastructure.
Which is just wild.
It's crazy. And then we'll examine how major exchanges are deploying autonomous AI agents directly into the financial system.
And finally, we will break down how Washington is, attempting to codify all of this into law and who actually benefits from that new rule book. So let's start with the immediate catalyst for this sub-60K price action. The liquidity drain we're seeing in Q2 of 2026 is severe.
Severe is putting it lightly.
Yeah. Bitcoin is on track for a rare back-to-back quarterly loss, which, that has only happened twice before in its entire history.
Right.
Following a 22% drop in Q1, we're looking at an estimated 12 to 13% contraction for Q2.
Yeah, it's heavy.
The asset is sitting roughly 53% below its October 2025 all-time high of over $126,000. But to really understand the sell-off, we have to look outside the digital asset ecosystem. The pressure is coming directly from the Federal Reserve and the macro environment under Chair Kevin Warsh.
Right, because the broader monetary policy completely dictates the flow of risk capital, and Warsh has engineered a remarkably hawkish environment. The specific metric driving this is core PCE inflation.
The Personal Consumption Expenditures Price Index, right?
Exactly. It's currently stubborn at 3.3% year over year. But the truly alarming metric for the Federal Open Market Committee is that the annualized rate over the last 3 months...
Oh, wait, the 3-month annualized?
Yeah, it's running at 3.8%.
Wow. Okay, I want to trace the mechanics of that inflation data through to the crypto markets. Because, the narrative for years was that Bitcoin was the ultimate debasement trade.
The inflation hedge, yeah.
Right. The scarce asset you buy to hedge against fiat currency losing its purchasing power.
Yeah.
But that trade is aggressively unwinding right now. What is happening mechanically there?
So basically, the debasement trade relies on a really specific sequence of events. Central banks print money, interest rates stay low, fiat loses value, and so capital flees into scarce assets like gold or Bitcoin.
Makes sense.
But the current mechanics are operating in reverse. Because core PCE is accelerating to 3.8% annualized, the market knows Warsh is going to hold interest rates higher for longer.
Right.
And high interest rates mean higher yields on U.S. Treasury bonds. So global capital chases that high yield, which creates this immense demand for U.S. dollars.
And obviously, a stronger dollar mathematically pressures dollar-denominated assets. I mean,
right.
the U.S. dollar is currently near a 7-month high.
Right.
So institutional capital looks at the landscape. They see a strong dollar and high risk-free yields, and they decide they don't need a static hedge against debasement anymore.
Exactly. Instead, they're rotating that capital into productive yield and growth, specifically traditional tech and AI equities. I mean, the Nasdaq surged 25% over a recent 2-month stretch, while Bitcoin just bled out.
This brings us directly to the U.S. spot Bitcoin ETFs, which, I mean, they act as the primary gauge for this institutional capital rotation. The contraction in these funds is staggering. We've tracked 7 consecutive weeks of net outflows.
It's massive.
In June alone, over $4 billion has exited these vehicles, dropping total ETF assets under management from a peak of like $100 billion down to around $72.8 billion.
Yeah.
It's like the market built this massive multi-billion-dollar reservoir for institutional capital, but someone just opened the floodgates at the very bottom.
That's a perfect analogy.
Let's look closely at the mechanics of these ETF outflows, though. When an institution decides to exit, it's not just a digital number ticking down on a screen somewhere.
No, it's a very physical and mechanical process.
Right. Authorized participants, the, specialized financial institutions that ensure the ETF price matches the underlying net asset value, they're actively stepping in. If selling pressure pushes the ETF price below the value of the underlying Bitcoin, these authorized participants buy the discounted ETF shares, they redeem them with the fund sponsor, and receive the actual physical Bitcoin.
Right, which they then dump onto the open spot market to lock in the arbitrage profit.
Exactly. That mechanical dumping is what drives the spot price down. But looking at the data, this exodus is not uniform across the board, is it? I mean, are all ETFs suffering equally, or is there a divergence in who is holding the line?
There is a massive divergence, and it's actually one of the most critical data points we have right now. Legacy, high-fee products like Grayscale's GBTC, they're experiencing expected sustained hemorrhaging.
Sure, because of the fees.
Exactly. But we are also seeing severe single-day outflows from the low-fee darlings of the space. Like Fidelity's FBTC saw 148 million exit in a single session.
Oh, wow.
And ARK's ARKB lost 62 million.
Wait, really? 62 million in one day?
Yeah, in a single day.
But yet BlackRock's IBIT ETF is somehow defying gravity here.
Oh, IBIT is operating as a complete systemic liquidity vacuum.
How so?
Well, on days when the broader ETF market sheds hundreds of millions of dollars, IBIT is frequently absorbing 60 million in net inflows.
That makes no sense. Why?
It indicates a real bifurcation in institutional strategy. So tactical, short-horizon momentum traders are dumping their positions across all these various funds, but a distinct block of deep-pocketed, long-horizon capital is treating the sub-$60,000 level as an accumulation zone.
Okay, I see.
And they are choosing BlackRock as their exclusive vehicle for that exposure.
And as that spot price drifts closer and closer to 60,000, we hit this sort of mechanical trapdoor in the derivatives market. I want to spend some time on this because it explains the extreme, violent volatility we see at these specific psychological price levels. We really need to talk about the short gamma trap.
Oh yeah, this is fundamental to understanding market microstructure.
So break down what this means for the listener.
Sure. So in the options market, institutional players frequently buy put options to hedge their portfolios. A put option gives them the right to sell Bitcoin at a specific strike price. And in this current environment, $60,000 is the heavily concentrated strike.
Okay, so institutions are buying insurance, basically, against Bitcoin dropping below 60K. But for every buyer of a put option, there has to be a seller, which is usually a large market maker. And market makers are in the business of collecting premiums, right? Not taking directional bets on the price of the asset.
Correct. The market maker wants to remain what we call delta neutral.
Okay, remind us what delta is again.
Delta measures how much the price of the option changes for every $1 move in the underlying asset.
Right.
But delta is not static, and this is where gamma comes in.
Okay.
Gamma measures the rate of change of delta. As the spot price of Bitcoin falls closer and closer to that $60,000 strike price, the delta of those put options accelerates rapidly.
which means the market maker's exposure to a loss is accelerating exponentially.
Exactly. Because the market maker sold the put, they are inherently short gamma. To stay neutral and hedge this accelerating risk, they are mechanically forced to short the underlying asset.
Ah.
Yeah, they have to aggressively sell spot Bitcoin or short perpetual futures just to balance their books.
Oh, man. So it creates a ruthless feedback loop. The price drops towards 60K. The market maker's models trigger automated selling to hedge their short gamma exposure. That spot selling drives the price even closer to 60K, which increases the gamma, which forces them to sell even more spot Bitcoin.
Right, it's a downward spiral.
When you layer that algorithmic derivative selling on top of the authorized participants dumping Bitcoin from ETF redemptions, you get a systemic liquidity vacuum. The floor simply gives out.
And that systemic compression, it doesn't happen in a vacuum. It directly attacks the balance sheets of corporations that built their models on the assumption of infinite liquidity and perpetual price appreciation.
Which brings us perfectly to Strategy Inc. We need to look at how this macroeconomic environment is stress testing the absolute largest corporate holder of Bitcoin in the world.
It's a huge test.
Yeah. As of right now, they hold roughly 847,363 Bitcoin, acquired at an average cost of $75,651 per coin. With spot prices below 60K, they are heavily underwater on a massive position.
All right.
But the real issue isn't just the price drop. It is how the market is forced to perceive that drop due to accounting regulations.
Yeah, the introduction of the Financial Accounting Standards Board Rule ASU 2023-08, that changed the corporate game entirely.
Okay, break that down to us.
Well, previously, digital assets were treated as indefinite-lived intangible assets.
Yeah.
So companies had to write down the value if the price dropped, an impairment charge, but they could never write it back up if the price recovered unless they actually sold the asset.
Right, which was super clunky.
Extremely clunky. So ASU 2023-08 comes along and mandates true fair value, mark-to-market accounting on a quarterly basis.
Well, wait, let's clarify the real-world impact of that. Because marking-to-market provides transparency, sure, but when Strategy Inc. reports a staggering $14.47 billion operating loss for Q1 2026, because the price of Bitcoin fell, that is technically just a paper loss, right?
Yes.
It isn't a cash flow loss. They didn't actually lose $14 billion in operating capital.
Yeah.
So why is the market punishing their stocks so severely for a non-cash accounting adjustment?
You're completely right that it is a non-cash paper loss, but in public markets, perception dictates liquidity.
No.
When an institutional investor screener flags a $14 billion quarterly loss, it heavily impacts algorithmic trading models and fundamental valuations. The stock plummeted 81% from its peak, dropping to around $82 a share.
Wow.
But more critically, that paper loss just obliterated the company's enterprise MNAV, the net asset value ratio.
Right, and the enterprise MNAV is calculated by taking the company's equity market capitalization, adding its debt and preferred stock, and dividing that total by the current spot value of their Bitcoin holdings.
Exactly.
Historically, Strategy Inc. commanded a significant premium on that. The market valued the equity higher than the raw Bitcoin because investors were basically paying for the management team's proven ability to accretively acquire more coins through capital markets.
But that premium has evaporated. The enterprise MNAV has fallen below 1.
Below 1.
Yeah, the market is now pricing the company at a discount to the raw assets on its balance sheet, treating it more like distressed debt than a premium technology equity. And that discount mathematically breaks their entire acquisition model.
I want to really dig into this breakdown because for years, this model was sold to the market as an unstoppable financial flywheel.
Yeah, the perpetual motion machine.
Right. The thesis was elegant. Issue convertible debt or preferred shares, use the capital to buy Bitcoin. The resulting Bitcoin premium drives the stock price higher, which then allows you to issue more debt against the inflated equity to buy even more Bitcoin.
Right.
How does a mechanism that's successful suddenly seize up and start spinning in reverse?
Well, the seizure is a direct result of the company's own strict governance protocols regarding shareholder dilution.
Okay.
The primary engine for raising capital over the last few years has been their digital credit preferred stock, specifically the tranche trading under the ticker STRC.
Okay.
The par value, the issuance face value of STRC is $100. But currently, the market has discounted STRC by 26%, leaving it hovering around $74.
And why does that specific discount shut off the engine?
Because Strategy Inc. has a really rigid internal rule. They will only issue new shares of preferred stock to acquire Bitcoin if those shares can be sold at or above par value.
Let's explain why that rule exists. If they issue new shares at $74 to buy Bitcoin, they are essentially selling equity for less than the underlying Bitcoin backing that equity is worth.
Exactly.
It's highly dilutive. It destroys the equity value for every existing shareholder. It is the definition of a death spiral.
Precisely. So to protect shareholders, they shut the funding window. They just can't raise new capital through preferred shares. But here's the catch. The obligations attached to the shares they have already issued do not disappear.
Right.
The cumulative dividend obligations across their various preferred share classes, STRC, STRK, STRF, STRD, and STRE, have ballooned to an estimated $1.7 billion annually.
Let us contextualize that $1.7 billion obligation against their actual operations, because before they became a Bitcoin proxy, Strategy Inc. was an enterprise software company.
And they still are, technically.
Right, technically. That core software business currently generates roughly $124 million a quarter in revenue. And that is top-line revenue, not profit. So they are generating roughly $500 million a year to service a $1.7 billion annual dividend requirement. They're facing a $1 billion structural deficit.
Which forces the board into an incredibly difficult corner. When the capital acquisition engine is broken, how do you plug a $1 billion cash flow hole?
Yeah, how do you?
Well, they have 3 levers to pull, and all of them signal distress to the market.
Okay, what's lever 1?
Lever 1, they break their own governance rules and dilute the common stock at a severe discount.
Wix. Okay. Lever 2.
Lever 2, they drain their corporate cash reserves, which currently sit between $871 million and $1.4 billion, but that only buys them a few quarters of runway.
Or lever 3. They do the unthinkable for a company whose entire corporate identity is built on diamond-handing the asset. They sell the Bitcoin.
And we have evidence they are already pulling these levers. Most notably, they recently liquidated 32 Bitcoin to cover immediate dividend shortfalls.
I have to challenge the significance of that, though. Selling 32 Bitcoin when you hold a treasury of 847,000 is mathematically insignificant.
It's tiny.
It's a fraction of a rounding error. Are we overstating this? Is this really a broken flywheel, or is the market just hyperventilating over standard treasury management?
I mean, it is mathematically insignificant, but it is psychologically and structurally catastrophic.
Why?
In credit markets, signaling is everything. Strategy Inc. built a multi-billion-dollar debt structure on the explicit promise that the underlying collateral of the Bitcoin would never be sold.
Yeah.
The moment you sell even one coin to service debt, you prove to your creditors that the core operating business cannot support the leverage. The flywheel has stopped accumulating and has basically begun cannibalizing itself to survive.
And the horizon looks even darker when we look past the immediate dividend yields. There's a maturity wall approaching.
Oh, the 2028 convertible note wall. It's massive. Strategy Inc. issued billions in convertible debt bonds that give the holder the option to convert the debt into common stock at a specific predetermined price. But the lowest conversion price on those 2028 notes is around $150.
So when those notes mature in 2028, the debt holders are going to look at a stock currently trading at $82 and a conversion option at $150. Mathematically, no rational actor converts.
Exactly.
They will demand their principal returned in cold, hard cash.
And if the company has already drained its $1 billion cash reserve to pay the preferred dividends over the next 2 years, they will face a severe liquidity crisis in 2028. They will be forced to liquidate billions of dollars worth of spot Bitcoin directly into the open market to pay off the bondholders.
Wow.
Strategy Inc., just by virtue of its massive leverage, has transitioned from being the asset's greatest champion to a localized systemic risk for the spot market.
That is a staggering shift in narrative. The corporate leverage bet on pure spot exposure is failing under the weight of traditional fiat obligations.
Wow.
But, here is where the dynamic of this industry becomes truly compelling.
Right.
While the corporate treasuries are trapped, the actual producers of the network, the mining companies that secure the blockchain, they recognized this vulnerability months ago, and they have executed a profound architectural pivot away from pure play mining.
The divergence in survival strategies between corporate holders and miners is just stark. To understand why the miners pivoted, we have to examine the brutal economics of block production in 2026. The margin compression is just unprecedented.
The primary driver of that compression was the April 2024 halving. We don't need to re-explain the code, but the economic reality is that block rewards dropped from 6.25 to 3.125.
Right.
Overnight, miners were expending the exact same amount of energy and computational power for half the top-line revenue. But it wasn't just the halving.
No, not at all. The difficulty of mining has completely compounded the pain. The global network hash rate, the aggregate compute power competing for those reduced rewards, has increased by 24% over the last year.
Wow.
It is a compounding squeeze. Top-line revenue is cut in half, while the capital expenditure required to stay competitive increases by a quarter.
We have concrete data on how deeply this cuts into the balance sheet, actually. Riot Platforms, one of the premier publicly traded miners, reported their Q1 2026 production metrics. The direct cost to mine a single Bitcoin was $44,629.
And it is vital to note that this figure excludes the depreciation of their ASIC mining hardware.
Right. When you factor in the accelerated depreciation schedules of those specialized machines, corporate overhead and debt servicing, and compare it to a spot price struggling to hold $60,000, pure play mining is functionally a dead-end business model.
Yeah, and the smartest executives in the mining sector realized that their equity could no longer trade simply as a high beta proxy for the price of Bitcoin. To survive, they had to redefine what their companies actually did.
Interesting.
They recognized that their core competency was not hashing SHA-256 algorithms. Their true, irreplaceable asset was their ability to secure massive industrial power contracts and build ultra-high-density electrical infrastructure in remote jurisdictions.
It makes me think of a 19th century gold rush analogy, but with a structural twist.
Oh, I like this. Go on.
Imagine a mining conglomerate operating in a remote valley. They spent a fortune building a private railroad through the mountains and damming a river to generate the massive water pressure needed to wash the ore. For years, they pull gold out of the ground and make a fortune. But eventually, the veins run dry. It costs more to dig than the gold is worth.
Right, the margins flip.
Exactly. The traditional miners go bankrupt. But this specific company realizes they hold a monopoly on the infrastructure. So instead of digging for gold at a loss, they pivot. A massive logging industry moves into the valley, and the miners start leasing their private railroad and their hydroelectric power to the loggers at a premium.
That is exactly the strategic pivot we're seeing, and the logging industry in this scenario is high-performance computing and artificial intelligence.
Of course.
AI research labs and large language model developers have a virtually insatiable demand for exactly what Bitcoin miners control: massive megawatts of power and the physical real estate equipped with the heavy cooling infrastructure necessary for dense server racks.
And the miners are deploying substantial capital to own the entire vertical stack.
Yeah.
Look at Marathon Digital trading under MRA. They didn't just buy more mining rigs, they executed a $1.5 billion acquisition of Long Ridge Energy and Power.
A digital asset miner outright purchased a 505-megawatt natural gas power plant in Ohio. It's crazy.
Riot Platforms is executing a similar strategy. In their Q1 2026 earnings, Riot reported $33.2 million in revenue generated entirely from non-mining data center operations.
Yeah, they secured a massive 50-megawatt hosting agreement with AMD, basically providing the foundational IT capacity for a legacy semiconductor giant.
And even more aggressively, Riot announced a strategic partnership with Terrestrial Energy to explore the integration of small modular reactors, SMRs.
Yes.
They are actively modeling the deployment of carbon-free baseload nuclear power directly on site to run AI compute and mining operations, like nuclear-powered Bitcoin mining and AI.
And the market has completely recognized this metamorphosis, and the capital reallocation is severe. Institutional investors are actively dumping spot exposure and buying the infrastructure.
Right. The numbers are wild.
Yeah. Over the trailing 12 months, while the spot-linked IBIT ETF dropped 44%, the WGMI ETF, which aggregates these publicly traded miners, surged an astonishing 244%.
This capital rotation highlights the economic power of dynamic energy arbitrage. By owning the generation layer, the power plants, and the consumption layer, the data centers, these companies are entirely decoupled from the volatility of Bitcoin. They actively route electrons to wherever the yield is highest at any given second.
Let us break down the mechanics of that arbitrage, because it's brilliant. They have 3 distinct revenue channels they can toggle between.
Right. Break down scenario 1.
Scenario 1. The spot price of Bitcoin rallies aggressively, making block production highly profitable. They direct all their power to the ASIC rigs and mine Bitcoin.
Makes sense.
Scenario 2. A severe weather event, like a heat wave in Texas, causes the local energy grid to experience critical load. The grid operator offers massive curtailment credits, effectively paying industrial users a premium to shut down.
So they just turn off the machines.
Exactly. The miner turns off the ASICs instantly and sells their generated power back to the state, often at a higher margin than mining.
Wow. And scenario 3 is the AI compute demand.
Right. They partition their high-density racks, install GPUs instead of ASICs, and lease the compute space to AI developers on long-term, fixed-yield contracts, providing a stable, predictable cash flow that traditional mining never could.
They have evolved from speculative digital proxies into foundational, utility-grade infrastructure monopolies. It's incredible.
It really is. And while the miners are radically re-engineering the physical, thermodynamic layer of the industry to support artificial intelligence, the major digital asset exchanges are executing a parallel evolution.
Yeah.
They're rebuilding the digital infrastructure to weave AI directly into the fabric of global capital markets.
This brings us to Coinbase and their strategic transition from a simple retail brokerage into what CEO Brian Armstrong defines as the everything exchange. Because the old business model of taking a 1.5% fee every time a retail user market buys Bitcoin is just a race to the bottom.
Liquidity is completely commoditized now.
Right. To survive, Coinbase is building the rails to unify and capture global liquidity across all asset classes.
And the most ambitious pillar of this transition is the push into tokenized traditional equities.
Explain that.
Coinbase is actively constructing the legal and technological framework to take U.S. blue-chip stocks, your Apples, Teslas, Microsofts, tokenize them as digital assets, and allow them to trade 247 on decentralized cryptographic rails.
But wait, why incur the massive regulatory headache of tokenizing Apple stock when Americans can already buy fractional shares on Robinhood with zero commissions? Like, what is the actual market inefficiency being solved here?
The inefficiency isn't in the United States, it's global. The legacy financial system relies on correspondent banking, SWIFT messaging, and the depository trust company for clearing and settlement. That infrastructure is heavily siloed and expensive. As a result, there are roughly 4 billion adults globally who are completely unbrokered.
4 billion.
Yeah, they have smartphones and internet connections, but no legal or practical mechanism to access the wealth generation engine of the U.S. equities market. By placing tokenized equities on a blockchain rail, Coinbase circumvents the legacy clearinghouses. They are offering instant, global, peer-to-peer settlement for U.S. securities.
So they are building the pipes to funnel global retail liquidity directly into U.S. markets.
Exactly.
And they aren't stopping at public equities. They are systematically targeting the private risk capital markets as well. They have launched pre-IPO perpetual futures for highly coveted, heavily gate-kept private companies like SpaceX, OpenAI, and Anthropic.
This is a profound structural workaround. I mean, think about it. In the traditional system, the immense value creation of a company like SpaceX is captured entirely by venture capitalists and accredited high net worth individuals in the private markets.
Right. Retail's totally locked out.
By the time the company executes an initial public offering, the exponential growth phase is largely over. The retail investor is functionally buying the top to provide exit liquidity for the VCs.
Wow, yeah.
But Coinbase is utilizing crypto-native derivative contracts, perpetual futures, to allow a retail user in Brazil or Indonesia to gain price exposure to OpenAI's valuation before it goes public.
That's a game changer. But the products they are shipping are only a reflection of a radical internal restructuring. How Coinbase operates as a company has fundamentally changed. I mean, they have heavily integrated artificial intelligence into their corporate structure, deploying 1,200 full-time autonomous AI agents.
1,200. And the productivity metrics associated with these agents are causing shockwaves in tech infrastructure circles.
I bet.
Because these are not large language models acting as glorified search engines. They are autonomous, operational, and coding agents integrated directly into the company's continuous integration and continuous deployment pipelines.
Let us explain how an AI agent actually codes, because it sounds a little like science fiction. It's not just a human asking ChatGPT for a Python script.
Exactly. In a traditional software environment, a human engineer writes a block of code, another human reviews it, it goes to a testing team, and then a deployment manager pushes it live.
Right. Lots of handoffs.
At Coinbase, an AI agent writes the code based on a high-level prompt. It then autonomously spins up a testing environment, compiles the code, and tests it for bugs. If it fails, the agent reads the error logs, rewrites its own code to fix the bug, tests it again, and upon passing, autonomously submits a pull request to the main repository.
That is wild. Because of these autonomous loops, Coinbase has shrunk massive engineering pods down to teams of one. A single human engineer now acts as an orchestrator, basically directing a swarm of AI agents.
Yeah, and through this integration, Coinbase has doubled their year-over-year developer code output while simultaneously driving down their bug and regression rates.
And they are weaponizing that internal AI competency to capture retail market share. They have externalized the technology by launching Coinbase Advisor, which is an AI agent integrated directly into the retail application.
But this is where it crosses a massive regulatory Rubicon.
How so?
This is not a chatbot providing generic educational material with a not financial advice disclaimer. Coinbase went to the Securities and Exchange Commission and formally registered this AI software as a legal investment advisor.
Wow. I have to push back on the mechanics of the compliance, though. The SEC framework for fiduciaries is built entirely around human accountability.
Right.
If a human financial advisor breaches their fiduciary duty, engages in unauthorized trading, or maliciously drains a client's account, they lose their license, their firm gets fined, and the individual potentially faces federal prison. How does the SEC legally hold a piece of software accountable? If Coinbase Advisor hallucinates a data point, misinterprets a macroeconomic trend, and aggressively tax loss harvests a client into a 40% portfolio drawdown, who goes to jail?
That is the exact legal friction point corporate lawyers are wrestling with right now. The current legal framework treats the AI not as an independent entity, but as a proprietary algorithm deployed by the registered corporation.
So it falls on the company.
Therefore, Coinbase, the corporate entity, assumes the ultimate liability for the actions of the agent. If the AI breaches fiduciary duty, the SEC fines the corporation, and the executives who authorize the deployment bear the regulatory scrutiny.
That is an immense legal risk.
It is, but Coinbase views it as necessary to establish the foundation of what Brian Armstrong calls the agentic economy.
Agentic economy. This is the thesis that the future of digital commerce will not be driven by human-to-human transactions, but by autonomous machine-to-machine interactions.
Right.
But for an AI agent to actually operate in a market, to hire other agents, to pay for API calls, to execute trades, it faces a hard stop when it interacts with the legacy banking system.
Completely. An AI agent cannot satisfy traditional know your customer or anti-money laundering protocols. An AI cannot walk into a bank branch with a driver's license.
Obviously not.
It cannot pass a CAP-TCH screen specifically designed to keep bots out of financial portals. Therefore, an AI agent cannot open a fiat checking account.
Which means the only native financial rail an AI can use is cryptography.
Exactly. AI agents require self-custodial cryptographic wallets. They interact natively with blockchain protocols via smart contracts and APIs. They can execute thousands of microtransactions a second, paying other agents in stablecoins to optimize yield, scrape data, or execute trades.
So the digital asset infrastructure is no longer just a casino for human speculation. It's becoming the foundational settlement layer for autonomous machine commerce.
Yeah, that's exactly what's happening.
But the collision of these two worlds' AI fiduciaries executing high-frequency trades and global tokenized equities settling on decentralized blockchains has completely overwhelmed the existing regulatory framework.
Oh, completely.
The ambiguity of the 2020s, where agencies regulated by enforcement and press release, is just no longer viable. The rulebook has to be codified.
And that codification is finally moving through Washington via the Digital Asset Market Clarity Act of 2025, widely referred to as the Clarity Act.
The Clarity Act, right.
This legislation, H.R. 3633, has passed the House of Representatives and successfully cleared the Senate Banking Committee in May 2026. It represents the most sweeping structural overhaul of U.S. financial market regulations since the Dodd-Frank Act.
The fundamental achievement of the Clarity Act is resolving the jurisdictional civil war between the Securities and Exchange Commission and the Commodity Futures Trading Commission, right? For years, these two agencies have engaged in a turf war over who has the authority to police digital assets. The Clarity Act draws a hard boundary.
It splits the asset class structurally. The SEC retains exclusive jurisdiction over investment contract assets.
Meaning what, exactly?
These are tokens that function similarly to traditional equities, where the value of the asset relies primarily on the managerial efforts of a centralized founding team or corporation. The CFTC, conversely, is granted exclusive, explicit jurisdiction over the spot markets for digital commodities.
But the critical mechanism of the bill is how it handles the life cycle of a protocol. A token is not statically defined forever. The bill introduces the Mature Blockchain Test, which provides a legal pathway for a digital asset to transition from being an SEC-regulated security to a CFTC-regulated commodity.
And the mechanics of this test require strict decentralization metrics. To graduate to commodity status, the underlying code must be entirely open source, and crucially, no single entity, founder, or affiliate group can control 20% or more of the token supply or the network voting power.
I understand the underlying logic there. It mirrors the life cycle of a traditional startup going public.
How so?
Well, when a company is founded, it's highly centralized. A few founders hold all the equity and make every decision. As the company executes an IPO, issues secondary offerings, and compensates employees with stock, the founder's equity dilutes. The board expands, and ownership decentralizes across thousands of institutional and retail shareholders.
Right, that tracks perfectly.
So providing a mechanism for a protocol to prove it has decentralized makes structural sense. But we have to examine the regulatory trade-off here. If a token successfully dilutes founder control and transitions to the CFTC, aren't we structurally removing the primary consumer protection agency from the equation?
That is the precise vulnerability critics of the legislation are highlighting. We must analyze the historical mandates of these agencies.
Okay, let's compare them.
The SEC was constructed in the aftermath of the 1929 stock market crash with a singular driving mandate: protect retail investors from corporate fraud, require exhaustive public disclosures, and prevent insider market manipulation.
And the CFTC has a wildly different historical constituency.
Oh, vastly different. The CFTC was designed to oversee the derivatives markets for physical commodities: wheat, crude oil, natural gas. Their traditional market participants are highly sophisticated, heavily capitalized institutional traders, massive agricultural conglomerates hedging supply chain risk, and proprietary trading desks. The CFTC is structurally, culturally, and financially unequipped to act as a frontline police force for millions of unsophisticated retail investors trading highly volatile, algorithmic digital assets on mobile applications.
So the legislation provides immediate, desperately needed regulatory clarity for institutional capital. It gives Wall Street the legal certainty to deploy billions, but it shifts oversight of the assets to an agency that lacks the infrastructure and the mandate to protect the retail participant.
Exactly. And the bill makes several other aggressive moves regarding taxation and decentralized finance.
What else is in it?
The Clarity Act attempts to close major loopholes. It aggressively expands the 1099-DA tax reporting requirements for brokers, effectively eliminating the ability to shield digital asset capital gains from the IRS.
Got it.
It also addresses previous legislative oversights by closing a loophole in the Genius Act, officially banning third-party yield generation on passive stablecoins to prevent unregulated banking activity.
But the most controversial addition is Section 604, known as the Blockchain Regulatory Certainty Act.
Section 604 creates a massive safe harbor.
How does it work?
It explicitly exempts true, non-custodial, decentralized finance developers, DeFi developers, from being legally classified as money transmitters.
Wow.
This means developers who write smart contracts that allow peer-to-peer trading do not have to register with the Financial Crimes Enforcement Network, they do not have to acquire state-by-state money transmitter licenses, and they are not required to enforce bank-level compliance.
Which transitions us directly into the real-world socioeconomic consequences of this rulebook. We have to analyze who is protected, who is exposed, and who actually benefits from this regulatory architecture. And before we explore this data, I must explicitly state for our listeners, as we discuss the political, social, and demographic impacts of the Clarity Act, we are not endorsing any specific political viewpoint, nor are we taking a policy side. Our sole objective is to impartially report on the empirical data and the perspectives raised by policy advocates in our source material.
That impartiality is vital because the data reveals that the impact of this legislation is demographically asymmetrical.
Okay, unpack that for us.
To understand why, we have to look at who actually utilizes this asset class. Recent data from Pew Research indicates that 1 in 5 Black adults in the United States invest in or utilize cryptocurrency. That is a highly significant adoption rate compared to traditional equities.
We need to understand the structural why behind that adoption rate, too. It's not arbitrary.
No, not at all.
Historically, marginalized communities have been systematically locked out of the traditional financial mechanisms that generate generational wealth. They have faced decades of redlining, discriminatory lending practices, and high barriers to entry imposed by legacy banking gatekeepers.
Right.
So digital assets presented a parallel system. A decentralized, permissionless architecture, where anyone with a smartphone and internet access could interact with global capital markets without requiring the approval of a traditional loan officer or broker.
However, policy organizations, specifically the Joint Center, are raising severe alarms regarding how the Clarity Act impacts this specific demographic. Their central thesis is that the legislation provides the illusion of regulatory safety for the market without enforcing the actual mechanical reality of consumer protection.
Their argument can be synthesized in a single phrase, really. Access without protection is not the same as opportunity. Because Black households, on average, hold a fraction of the net wealth of their white counterparts, they have a significantly lower financial cushion to absorb catastrophic market drawdowns.
Exactly.
And the Clarity Act, by shifting jurisdiction and exempting DeFi, structurally removes the guardrails that prevent retail traders from destroying their portfolios.
We can point to the specific guardrails that are missing, too.
Let's do it.
First, the legislation imposes no maximum leverage limits for retail traders. In traditional equities and forex markets, regulations strictly cap the amount of margin a retail investor can utilize, preventing them from taking on debt that could wipe out their entire net worth in a minor price swing. The Clarity Act leaves digital commodity leverage largely unrestricted.
That's a huge risk.
Second, there are no mandatory suitability checks. A centralized broker is not legally required to verify if a retail investor actually has the income or the financial stability to absorb the massive risks associated with highly volatile tokens.
And we are seeing the consequences of the third missing guardrail right now in this sub-$60,000 market crash. The lack of systemic circuit breakers.
Oh, yeah.
When traditional equity markets experience extreme cascading sell-offs, exchanges like the NYSE are legally mandated to halt trading. They pause the market to allow algorithmic liquidation cascades to reset and to prevent human panic selling from driving the asset to zero.
But the Clarity Act does not mandate these structural circuit breakers for digital asset exchanges. As a result, the cascading derivative liquidations and the short gamma trap we discussed earlier are allowed to run unabated, devastating retail portfolios.
Right.
Furthermore, the Section 604 exemption for decentralized finance means that the most speculative, highly complex corners of the market, where smart contract exploits and algorithmic flash crashes are common, will operate with virtually zero proactive federal oversight. Regulators are only empowered to intervene after a catastrophic loss has occurred, rather than requiring the architectural safety standards to prevent the loss in the first place.
So the synthesis of the critique is that the Clarity Act organizes the plumbing of the industry beautifully for the institutional giants. It provides BlackRock, Fidelity, and Wall Street with the legal certainty required to deploy billions of dollars into digital commodities. But it leaves the everyday retail participant completely exposed to the raw, unmitigated violence of an algorithmic market.
Exactly. It invites retail investors into a highly complex global casino, but structurally removes the safety nets.
That is the core systemic risk. For communities that enter the digital asset ecosystem seeking economic mobility and an escape from legacy financial barriers, a poorly regulated market contraction, like the violent slide below 60K we are currently analyzing, is exponentially more devastating.
Yeah, the architecture is being solidified for institutional capital, but the retail user is still being forced to drink from a highly volatile fire hose.
Let us pull all of these intricate threads together to understand the comprehensive picture here, because the through line connecting all of this data is remarkably clear. This June 2026 market crunch, pushing the asset below 60,000, is not just a standard cyclical bear market.
No, it's definitely not.
Yep. It is not just red candles on a trading view chart. It is a violent foundational restructuring of the entire digital asset space. The old operational models are breaking. They heavily leveraged corporate bets, like Strategy Inc.'s perpetual acquisition flywheel, are cracking under the pressure of real-world cash flow deficits and unyielding FASB accounting rules. The era of simply holding spot exposure on a corporate balance sheet and assuming infinite price appreciation is dead.
But from the destruction of those outdated models, the actual tangible infrastructure of the ecosystem is maturing at an unprecedented velocity.
Exactly.
The network producers, the miners, are abandoning pure speculative behavior and physically transforming into foundational power utilities and AI infrastructure monopolies. The exchanges are moving far beyond simple retail brokerage fees, launching autonomous SEC-registered AI fiduciaries, and engineering the rails for global tokenized equities.
And Washington is finally, albeit clumsily, and with significant structural flaws, laying down the permanent legal framework that will govern this new architecture. And this brings the entire narrative back to you, the listener. You consume these deep dives to cut through the noise, to take off the tune-out hoodie and actually comprehend the mechanics of the market.
Because at this point, whether you own a massive portfolio of digital assets or whether you own absolutely none at all, it no longer matters.
Right.
The rails being constructed in the pressure cooker of this market, the tokenized global equities bypassing correspondent banks, the legally recognized AI financial agents executing microtransactions, the dynamic energy arbitrage shifting power between blockchains and national grids, these are the exact technologies that will dictate the plumbing of the entire global financial system in the 2030s.
This is no longer merely a conversation about cryptocurrency. It is a fundamental re-engineering of how value, compute, and capital move across the planet.
And as we look toward that heavily automated horizon, I want to leave you with one final structural thought to consider.
Go for it.
If we are rapidly approaching a reality where SEC-registered AI agents control their own self-custodial wallets, where they execute high-frequency algorithmic trades 24/7 without the need for banking intermediaries, and where they interact exclusively with other autonomous agents across decentralized tokenized markets, does human behavioral economics even apply anymore? Or are we currently witnessing the birth of a global financial market driven entirely by cold, unemotional machine logic, where human panic, fear, and greed are systematically engineered out of the equation?
A completely rational market stripped of human fear. Now that is a thought to keep you analyzing the charts tonight. Thank you for joining us on this exploration of the Great Restructuring. Don't zip up, don't tune out, stay curious. We'll catch you on the next Deep Dive.